This is Tom Hulick, CEO of Strategy Asset Managers. I'm here today with Joe Traba, our Senior Portfolio Manager, and also Alex Hagstrom. I'm one of our other portfolio managers, and we are going to talk about what's been happening with the markets and give you an update. We are definitely looking for some stability right now. We understand that there is a lot of stress out there in the markets, and we are going to cover several things. I would like to say that the call will probably be 10 minutes of commentary, and then we will open up for questions. Joe, let's kick it off. All right. Tell me how you're feeling.
Yeah, thank you, Tom. And first off, when we get this level of uncertainty, we do feel it and we do hear it. And we want to make sure that we know when we talk to you as we're going out more, let us know what's going on. And I think part of what we're seeing is just, yes, we know the markets are lower. We know the cost of everything has gone up. We see that when we go shopping. And there's a lot of uncertainty as people are going back to work, children going back to school. This all causes a lot of anxiety. We're also seeing a lot of geopolitical concerns. And again, with interest rates going higher. So we do know there's a lot of issues out there, but we also know how people are feeling and relating to these negative issues that they're hearing. What we like to add is what are the positives that are happening right now? When is this market going to go back up? Our cost of goods going to keep rising at this price? And, what does this do for my bottom line? If I'm living on a stated amount of income that I'm used to receiving every month, and now this cost has gone up dramatically, what's happening to me and my portfolio? So we'll go over some of the specifics of the negatives, also give you some positives, but also go over how companies are doing in this environment, which companies are doing well, and which ones, we think will continue to do well in this environment until we get out. So it's a lot to cover, but we'll be quick with those topics, and then Tom will open it up to some questions.
Alex, let's start it off with you and give us some updates on your side.
Yeah. So thankfully, we are seeing commodity prices, for the most part, fall significantly. And in general, when you see commodity prices go way up, as they did recently, they eventually come back down as supply and demand adjust. And it's very encouraging to see this happening today. Gas prices are down more than 25% from the peak in June. Copper's down more than 25%. I could go down the list, but the majority of commodities are down significantly right now. And that's exactly what we want to see as evidence that the capitalist process is still functioning, that the economy is healing from COVID, the lockdown, the stimulus, the war. Even with the war still escalating, gas prices have gone down. This has allowed the rate of inflation to fall for 2 months in a row. Oil will remain the key element determining whether that continues, but if oil and gas can remain where they are today, then June will have been the peak in inflation. And that's obviously going to be very beneficial for everyone.
Yeah, it's an interesting fact to know that we've talked about the peak of inflation, but there is a huge pain point for anybody on a fixed income. We will cover that topic with Joe's discussion as well. We understand that that inflation is a major topic, but we are seeing signs of an abatement there. Joe, why don't you start talking about what's on your mind?
So as we enter today, we're back down on the S&P down over 20%. So a lot of what's the negatives we're hearing, we have to remember the market is a discounting mechanism, and it is pricing a lot of these uncertainties into the market. And we can see that with inflation, and we can see that, again, with the choppiness of the market. It lacks conviction. Yesterday was a prime example where the market was up 200, down 200, up 200. It doesn't know how to react toward what the Fed's doing. So until we get some stability with inflation, we think the Fed is going to be, again, like they said, continue to be aggressive.
When do you
What
think
they're-
that's going to occur, Joe? I mean, we've been talking about this in our morning research calls. We have a Monday and a Friday research call for those in our audience. We talk for an hour about micro and macro issues. We don't have a crystal ball, as everybody knows, but we have been trying to set a timeline and what the expectations are for the inflation peaking, a potential bottoming of the market, recession, yes, a recession, no, definite slowdown, angst, all those areas, and how we're managing the assets for you.
Yeah, and that's a big point. Is we had said usually when you have this much every single time the market's down more than 15% in the first half of the year, the second half obviously is much better. So as we get in through the end of this year, why, what are my reasons to be invested in the market during this year? And again, when we look at how much negative the market's already priced in, what happens if we get some positives that come out? What happens if we do get some stability? And like Alex mentioned, oil prices or gasoline prices down, 90 days in a row, you start seeing the year over year comparisons go lower. And that really starts in the month of October. And that coincides with what Fed Powell said yesterday, that expecting maybe 2 more rate hikes and then done. We look at what the futures market's telling us as well. And it's now looking for the back half of 2023. They'll start doing some yield lowering interest rates actually. So maybe we have the month of November as the peak, and if the market starts smelling this earlier, that's when we can get some stability on both inflation and interest rates. What's that mean? It means that both companies and households have a better visibility of what next year is going to look like. So that's where we start seeing some things in the shorter term as we get data that's coming out that's going to be favorable to start maybe the Fed not be as aggressive with raising interest rates, because we could see inflation cool off. And as Tom mentioned, we're seeing some of the economic data cool off. One of those is housing. And as I think most people know here, Tom did recently buy a house. And what's people get nervous about is, okay, he's in a fixed mortgage. So that payment that he does is not going to adjust with interest rates going up. And for people that make over 100,000, their largest expense is living. And if you look at your mortgage and you're in fixed, and most mortgages in the United States are fixed, that cost isn't going up. So we just need some stability with the cost of when we go grocery shopping. I think everyone here, when you've gone shopping, your bill is up at least 10%. What does that mean? Can we see some slowing down and actually not higher prices? Well, like Alex mentioned, a lot of the soybean and commodities, they're down a lot in the recent data. This takes time for it to work its way through the system. And same thing with energy. Except in California, we pay a higher tax on it, but the national average has definitely gone lower. So that transportation cost starts coming down as well. So we'll start seeing those kind of positives start coming back into the market.
So you're talking about inflation is definitely peaked and it's coming down. I don't want to get too granular there, Joe, as we are. So let's move on. We're seeing adjustments in inflation, but it is impacting the way that corporations and also stock prices are handling the markets these days. So Alex, I'd like you to talk a little bit about some of the outlook that you have as well.
Yeah, and so I think the most critical thing that I always want to stress when we're enduring this short-term volatility is that stocks are a very long-term investment, right? You own these cash flows for 30, 50, 100 years. You can give them to your grandchildren. So when we get these short-term disruptions, it can be beneficial to wait them out as they heal themselves. And that's how capitalism works, right? Capitalism naturally has ups and downs. It naturally has slowdowns and recoveries, bear markets and bull markets. These are all part of the system that allows the economy to continue growing. And, the economy has trended upwards for 100 years. The stock market's trended upwards for 100 years. And there's no reason to expect that, this short-term slowdown that we're experiencing is any different from the 50 other short-term slowdowns, we've experienced in the last century here in the US.
So what do you do in the meantime, Joe, Alex, for kind of this waiting period? We saw Jerome Powell increase interest rates by 75 basis points yesterday. The money market yields now are exceeding 3%. You've got short-term treasuries nearing 4%. Let's talk a little bit about the fixed income market and then also go over to equity specific sectors that we're covering.
Yeah. So what's been one positive here for those of you that are savers, just in the last few months, as we know, if you had cash in your savings account, you earn nothing, and that's been for a couple of years. Well, with the Fed last 3 rates of 75 basis points, like Tom alluded to, you now have money markets that are yielding over 2.5%. What we have to do is buy this money market fund, but again, that's a direct correlation with what the Fed's doing. There are treasuries and obviously corporate bonds that are now yielding 4%, and you're only going out like less than 2 years. So that's what the Fed does, and that's what's happened now with interest rates, and something that's attractive to some people with a short time horizon. You can get that yield. Now,
Alex, go ahead.
Now, I was going to say, when we go back to the sector allocation, because this is for me, when we talk to you, what does this mean to your portfolio? What do I own? And when are these stocks going to come back up? And during this interim, like Tom mentioned, what happens? And I do think there are companies, again, when earnings is going to be coming out in a couple of weeks, which companies are doing okay in this environment? And number one, it's companies that can raise prices. Well, what does that mean? Well, for example, Nestle. If you go shopping in kind of the middle aisle, those products that we always buy, they're able to raise prices because we need them. And those are some companies that are doing well. We also think about energy. I own energy stocks as well. And when I go fill up my tank, it's nice that I own those companies. So that's like a Chevron. If you're paying higher price of gas, why don't you own that company? Because they're able to raise prices as well. And then a kind of a third fact, I recently I have 2 younger children, and our family went to Disneyland. Well, Disneyland made more revenue, or is making more revenue, than pre-pandemic. How is that possible for theme parks? Well, they raise prices. So you can see a reoccurring theme here. It's which companies.
And they're serving alcohol too, right? Between 8
yes.
and
if you go to the California Adventure Park, but the traditional one is still not.
That's where you were, right?
That's where I was. And it's just, for me, it's you hear a lot of these negatives out there, and I know we're giving you some sound bites with some positives that we're seeing. My children went back to school. That's awesome. It's nice to have them back with that interaction. But what's a direct effect? Traffic's picked up, and you get more accidents. People are, and it's a fact, going back to the office. In New York, the subway, they're
begrudgingly.
Correct, begrudgingly. So it's some of these return to normalcy, but it's also causing some hesitancy because we haven't been out. We haven't seen people, I think, as a country, and that's just coming. So I do think where we're at is also where hopefully China will be getting at, and we pretty much shut off China. But what happens when they do open up again? And again, President Xi just finally left mainland China that we know of, and that's sending a message. It's okay to travel. They also lowered restrictions for people to come visit. And that's a big cod, not just for global shipping, but also for tourism and those assets coming out of the country where they've been locked down and not having to do anything. So I think there are some positives out there. And once we get some of these certainties, that's why I feel optimistic with a lot of the companies that we've not just mentioned, but some of the ones that we own that can get through this period.
Let's talk. Alex had a point earlier when we were discussing leading up to the call about how inflation eventually
Yeah, and
settles itself naturally.
in a functioning capitalist economy, inflation is self-defeating rather than self-reinforcing. And what I mean by that is the price rises, but that causes demand to fall. And then by the laws of supply and demand, once demand falls, price falls back down. It's a natural system. As long as the economy is capitalist and is functioning correctly, these things should be self-regulating. And it just becomes sort of a natural cycle.
Yeah, it's an interesting perspective to frame it that way. I appreciate you saying that, Alex. We also talked about how we think Christmas is going to come much earlier this year. Every year, you always notice when the Christmas trees go up in retail stores like Targets or the Home Depots, Costco's, but inventory levels are probably peaking and have spiked. And what do you do with all that inventory? You get significant discounts earlier than expected. You want to talk a little bit about that, Joe?
Yeah, and something that we had mentioned in the beginning of the year, we had huge inventory levels. And then we saw that with the companies when they reported, and these are the retail companies, reported earnings where their margins are getting smaller and they had the wrong product mix. So what do they do to get rid of that inventory? They discount it, they sell it. And that's, I get emails from a large of these companies, and it's a good time to be a consumer if you're looking to do some purchases. And that's how they get inventory out and eventually get their margins back. So that's usually takes a couple quarters. We're, I think more than halfway through that. And probably next year, they'll have some margin help, but it's still a good time to be a consumer as they're blowing out of inventory. The last point, if I wanted to talk about the midterm elections.
Very good. I was going to bring that up.
We've had a lot of people, and this has been a big discussion on people's just with what's happening with our current president and also what's going to happen. And we do like to just remind people the facts. Traditionally, when an incumbent has his midterm elections, he usually loses seats. Secondly, the third year of a president's cycle is the strongest year with an average gain of over 14%. So that's setting up how 2023 acts. What does that mean? What's that?
We hope.
And what does that mean? It means that policy doesn't change. So a lot of the fear 2 years ago, if you look back, was that we were going to have tremendous change in policy because we had one side have all three offices. Well, nothing really got done. And that was partly because we thought it was going to be so close, you wouldn't have the votes to get anything pushed through. So we fast forward to now with the midterm elections and the economy where it's at. What do you see happening? And that's, again, people, let's keep the vote with how the economy is doing. We keep it simple. And there's a lot of issues out there, but traditionally, historically, people vote with their pocketbook. How is the economy doing for me? And if they don't like it, that's the beauty of our country, you vote those people out. So I do think, again, we will get some more Republican seats. And the market likes having that gridlock. And that's, again, sets up with how historical tendencies set up. Now, Tom mentioned a good point. What happens if we don't get that? What happens if traditionally and how we're seeing things and it doesn't happen that way? It's, again, our key is not the politics, it's the policy. And again, remind people what we were expecting 2 years ago or what people were expecting and what ended up happening. So again, if I can just urge,
not a lot of changes on the tax side and policy side, which was favorable for all the people that postured to prepare for it. So that's good. We've got to focus on the policies, not the politics. We do think that there's going to be a shift in the House and the Senate. Not sure if there's going to be a majority in the Senate, but definitely a shift in the House of Representatives for the midterms. And if there is an outcome that turns out less favorable than what the media has been projecting, then we're prepared that way to make moves in the accounts that we have. Joe, outside of the politics, which we're seeing on a daily basis, because I'm getting bombarded by more texts that are capturing my eye. Hey Tom, look at this text, and I'm stupid enough to open up the text, and then I'm reading a Trump or a Biden endorsement, or a local person's endorsement. I want to talk about the job market.
This is, two things I want to mention on that. It's one, as technology's improved, so is phishing, and people able to send texts.
Yeah. Warning.
That's
big warning.
So don't click on links like Tom unless you know who that person is.
Yeah, we should reiterate that there is an enormous increase in phishing schemes, both email, texting. If you don't recognize an email, especially the URL or the text, do not click on it and do not open the link, because your cell phone as well as your email your cell phone can be hacked as well. And we all know how difficult it is to unwind and also protect your assets from some type of extortion, basically.
Yeah, and it's also the do not call. So sometimes when they send a blank email, just you responding to that email is now like, okay, they know a live person's on it. So just delete it. But what we're seeing with marketing, this is interesting. One of our clients is an executive for a marketing firm, and they're not seeing. So typically when you go into a deep recession or a bigger slowing, companies cut back on advertising. And what's interesting, he's not seeing the overall spending cutting back. It's just getting positioned. Like traditionally we used to
shift
look
in
at
other
ads.
areas which are more concentrated, right?
And again, so that's still happening where they're still spending. But one part is the participation rate. And why this is big, it's because we've had a lot of people not come back to work. And that's why we see unemployment low and a lot of job openings. So we're starting to, finally, the last couple of months, that means the number of people joining the workforce is starting to increase. So we're not back to the pre-COVID levels. We still have some more room to work. But again, that's important because now we're getting more people back to working. And as we know, wages have gone up. So that's a positive for when you look at a consumer household and how much revenue they're generating.
Yeah. Alex, what other key points do you want to make before we sum it up?
Yeah, I just think, I think in general, the war sort of obfuscated the natural peaking of inflation, which was driven by COVID, right? We had COVID, we'd had all these extreme government policies. They caused a massive inflation spike. And just as that inflation spike was finally easing, the war popped up. So we had these sort of two idiosyncratic events back to back. And because of that, it kind of, obfuscated the fact that the economy is still functioning. These were one-time events, and the economy will heal from both of them. It just needs more time.
Yep, I appreciate that. We had a couple of questions about what has been factored into the markets right now, and has inflation been factored in? Has a strong dollar? Has the geopolitical crisis been factored in? Inflation of the Reduction Act and/or tuition forgiveness cost? More money being printed. All these things are stressing the market. What has been factored in?
Yeah, that's a good point. And when we look at sentiment, we know sentiment short-term, and sentiment is it's at peaks that it's at levels that we haven't seen until there's already a major crisis. So people are very defensively positioned. Their sentiment is extremely low. They do have high cash balances. Historically, this is closer to bottoms. And this is kind of where we're seeing things. Now, how much of rate prices or rate increases are priced in? I do think Jerome Powell's been pretty scripted, and we could see again November being close to that being done with, specifically when we start.
So what,
seeing
another
inflation
50
data.
basis point hike in November?
So it's another 75 and then another 50 by the end of the year. And that's what the market's saying. And then lowering rates in 2023. So maybe we don't see 1.25. Maybe we see just a total of 150 and then a 25 or some kind of, and as we get closer to these dates, we'll get that. But I think that'll give some stability and like, okay, we're not on this raising hike cycle, and calm that down. And that coinciding with inflation numbers, like Alex mentioned, starting to slow down, but it really should be meaningful. And I'm just talking a few more percent. I'm not talking going down to 2%, but getting below, around 6%. That's just a factor of, again, oil prices going lower, and then rents are a little bit of lagging. As we've seen, home prices, they have come down, but just fractionally, and then rents always follow that a few months later.
Yeah. We've talked a while, actually. We've talked way over our 15 minutes, but a lot of important things to cover. We always talk about what you should know about how we're thinking about things. And Alex made the key point, and so did Joe, about that, economic slowdowns are always followed by recoveries. And when is the question. And it's just like any patient, you don't know how quickly you're going to recover, but it can happen, and it will happen if you have the best managers or advisors or physicians around you. And we consider ourselves experts in the area of investment management and also economic commentary. And so we do think that there is going to be a turn soon, and the markets could potentially react as early as the end of the year. And we have seen from the trough that we hit earlier this year, all of the data that was digested is starting to paint an additional picture. We do know that there is probably a recession on the rise. We did know that interest rates were going to increase. We do know that investor sentiment is very negative, but we have enough data in front of us to see signs that there is going to eventually be a turnaround in the right direction. What should you be doing about this right now? We're coming into the end of the year. We should have a discussion about tax gain and loss harvesting. Talk to your advisor about making sure that you are efficiently looking at your portfolios, making adjustments where there needs to be an adjustment. We have much higher interest rates, short-term interest rates that are now exceeding some of the equity dividends that are there for just idle cash. So that should be a discussion as well. But the demonstrated leaders that we own in our equity portfolios have really shined in comparison to the passive S&P 500 type returns. And active management will continue to outperform the passive strategies that are there. So once again, active strategies like strategy asset managers, equity and fixed income management should continue to outperform like we're demonstrating now. You should feel a little bit better about the commentary that you've heard, because Joe and Alex have done a good job at forecasting where we should be, and we don't anticipate anything other than future rate increases for sure. Definitely an abatement in inflation, and also if the consumer cracks, If the consumer cracks, then we have an additional problem. And at this point, we haven't seen that. We've still got a strong job market out there, which reinforces a better probability of a recovery happening sooner than later. Corporate balance sheets are still very strong. Even the consumer is strong out there. We talked about the consumer debt. We talked about variable debt. All these things are things that we factor in. I would like to say that there have been some incredible things that I've seen this year. My 87-year-old father broke his hip a couple weeks ago. He had a partial hip replacement. He had 3 dislocations in a week. And they were all put back into his socket was put back into, or ball was put back into the socket. But this was done so efficiently from a hospital, and the surgery was nearly pain-free. Precision incisions, pain management, efficiency of moving somebody in and out of the hospital. Incredible advancements in medicine that we're seeing. I'll just make that one point because my father is the benefactor of some of the modern medicine that's out there, and we know that there are others and better stories that are taking place. Technology is not slowing down. Be confident that our lives are going to improve dramatically over the next day, month, 6 months, several years. And we've selected some of the sectors, especially the technology sector, and some of the companies that are outperforming in that given area. Joe looks like he wants to say something, so I want to let Joe speak.
No, just as we wrap this up, the 2 big things that I like to talk about is there are reasons to be hopeful, to be positive. And when we have these extremes, and we can, again, talking to our clients, hearing what they're going through, if we need to make changes, we need to let you know. But I also think when it's darkest, like Alex said, that's when we're at these lows, and when things are going great, it's you don't need to be talking to your advisor. So I definitely, if something's changing on your end, please reach out to us. But I do think communication's key. And as we get through this, uncertain period in the markets, we will get through it. We always have, and there will be better days ahead.
Good. Do we have any questions that have popped up? I saw the one from Ben. We answered that. If anybody else has, there's a chat button at the bottom. We think we've covered everything. We want to thank everybody for being on the call today. If nothing comes up in the next 20 seconds, feel free to reach out to Joe, Alex, myself directly, or your advisor, or what we can do is we will make the recording available up on the website and distribute it out for your listening pleasure. Sorry that it went a little bit over. We do have another question coming out. Is the auto industry really healthy? They're shutting down orders after low quotas, literally selling out in minutes. A 2021 Ford Raptor is selling for $95K, even though it was purchased for $65K. Is this just a chip shortage? Many implications. There are lots of responses that I can think of for that, Joe. I mean,
I think this sounds like a broken record, but the pandemic acts as an accelerator. So you kind of think of the old traditional car manufacturers. I'll just use Ford and GM. What happened to them? Their market cap, I think, all collectively isn't even the size of what Tesla is. So they were slow to change, and they're now paying this kind of price to get back up to speed. And for us as a consumer, we have some pretty cool cars to choose from. And I think that's the encouraging as what new type of technology for driving comes out. Their cars are much better than what they were before. Using the word car is kind of a loose term because it's more like a computer. And that's where we're seeing the shortages in chips coming through. But it's really fascinating to see the innovation that's gone in this industry. And I think, we'll know who the players are in a couple of years, but it has definitely transformed over the past, 5 years. It's been a huge change. And that's good for us because we have better cars now.
Yeah.
And I would say that those semiconductor shortages in the auto and in other industries, those are definitely going to be resolved. We've seen, the US, every other country basically dedicate billions of dollars to semiconductor manufacturing capacity. Now it does take a significant amount of time to build a semiconductor foundry, and that's why the supply shortages don't ease immediately. But all those, that supply is in progress and it will come online, and that shortage will ease.
Yeah. Okay. Joe, do you want to cover any of the movements that we've made?
Yeah, and I just had a chuckle, Diana,
yeah,
just
I saw
responded to
that.
all of us. And again, buying a new vehicle. So again, these are some things that maybe it's good to hear, people doing these types of purchases. But just to go over some of the changes that we've done for our models, we did raise some cash. And we also, for the fixed income clients that have a portion in fixed income, we've been in very, very short duration. So we've had a tremendous amount of bonds come due this year. And that, as what Tom mentioned, we're just going out a couple of years and getting a 4% yield. So for the fixed income clients, those are some types of yields that you can get. And again, that's just been another kind of if you have cash sitting somewhere, make sure you're getting some yield on it.
Yeah. And then, for the sectors that we're concentrating on, the energy sector, we were talking about, Chevron, we were talking about the technology sector, healthcare sector. Do you want to just reiterate what you were talking about earlier?
Yeah, again, I think when you have this type of inflation, you want companies that can raise prices. We've went over energy. We went over some of the consumer staples. That's like a Nestle. I do think some of the select tech, when you have higher wages, what does that mean for companies? They're going to look to reduce that higher wage and get it automated. So I still think technology is a very good place to go, again, with certain types of companies. And then the third leg is we've mentioned a little bit of healthcare. And again, as people are going back to the hospital, the health insurers, which we do own some of those companies, they've done very well this year. And again, it's more and more people going back to the hospital and potentially more surgeries. And like Tom said, technologies really helped speed a lot of how pharmaceutical and healthcare companies do things. I think it still has more ways to go, and it is. So that's an area that we like as well. So these are more of the steady eddies that have good cash flow, and you're going to continue to use these types of products.
Right. Okay. Okay, I think we've talked enough today. I just want to thank everybody for participating on our calls. We try to give timely information and stay in front of a lot of topics that stress or actually make our clients excited. But we will have another update in October. We will have the commentary available in a printed format for you, which can summarize the talk that we had today. The recording will be available later today, as early as tomorrow, for those people who want to listen to our boring talk today. But we want to thank everybody for being here, and have a wonderful remainder of the month. And I think we'll make sure that we reach out and see if there is anything else that we can cover on the next talk for you all. Okay. Thank you very much, everybody. Shutting down.